Atlassian stock surged 8.1% in a single day, not because of a blockbuster earnings report or a surprise product launch, but because of a shift in tone between two world leaders and a wave of quiet confidence spreading through enterprise software. That's the surface. But the real story isn't just about one stock jump. It's about whether artificial intelligence can finally move from hype to real revenue for companies that power corporate workflows. The market just sent a signal: enterprise AI may be turning a corner. And that changes everything for how investors value companies like Atlassian. On May 15, shares of Atlassian team climbed to $86.61 following a diplomatic meeting in Beijing between former U.S. President Donald Trump and Chinese President Xi Jinping. While the summit produced few concrete trade agreements, the shift in tone, from adversarial to moderately optimistic, was enough to spark broad buying in technology stocks. The S&P 500 crossed 7,500 for the first time, reflecting renewed confidence in globally integrated sectors. For a company like Atlassian, whose tools are used across international teams, even a subtle easing in US-China tensions reduces operational uncertainty. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. But the rally wasn't just about geopolitics. It was confirmation that enterprise AI is gaining real traction. Two separate developments reinforced that momentum. Figma, the design platform, reported a 46% year-over-year revenue expansion, a number that analysts tied directly to early AI monetization within its product suite. At the same time, ServiceNow announced a multi-year AI collaboration with Experian, signaling long-term investment in AI-driven workflow automation. These weren't vague promises. They were revenue figures and binding partnerships. And together, they helped quiet earlier fears that AI would disrupt rather than enhance enterprise software platforms. That narrative shift mattered, and it lifted Atlassian along with the rest of the sector. The important part is not the stock surge itself. It's what's behind it, a growing belief that enterprise AI can be monetized at scale. Truist Securities reinforced this view, maintaining its buy rating on team with a $100 price target. The firm pointed to Atlassian's AI roadmap, particularly its Rovo credit framework, a usage-based system that charges customers for AI-powered actions within its ecosystem. This isn't just AI as a feature. It's AI as a revenue engine. Truist sees Atlassian not just as a software provider, but as a supplier of enterprise context, the structured data and workflows that make AI tools actually useful in business settings. That's a strategic moat. Atlassian's own results support the momentum. In its third quarter fiscal 2026 report, cloud revenue grew 29% year-over-year, accelerating from 26% the prior quarter and beating estimates by 4.5%. Data center migrations and the acquisition of DX helped fuel that growth. Leadership also pointed to rising adoption of the Teamwork Collection as evidence that customers are engaging with its AI-integrated offerings. Even with free cash flow impacted by severance costs, non-GAAP operating income came in above expectations. This wasn't speculative. It was financial proof of resilience. Still, the stock remains deeply depressed. At $86.61, Team is down 44% year-to-date, and trades 60.8% below its 52-week high of $220.89. A $1,000 investment 5 years ago is now worth just $407.94. That disconnect, strong cloud and AI fundamentals against a battered share price, highlights the volatility investors have endured. The 8.1% jump fits a pattern. Team has seen 33 moves of 5% or more in the past year, including a 3.8% drop just days earlier driven by rising treasury yields. This isn't a stable momentum play. It's a high-beta bet on enterprise AI adoption. Wall Street's outlook is split, which adds another layer of uncertainty. While Truist, BofA, and Cantor Fitzgerald project price targets around $100 to $107, Piper Sandler sees $175, and Bernstein SocGen holds a $295 target. Macri rates it outperform with a $130 estimate. That wide dispersion tells you there's no consensus on how fast or how far Atlassian's AI strategy will scale. Some see a slow rebuild. Others see explosive potential. The lack of alignment means the next catalyst, whether it's a major customer win, deeper Rovo adoption, or a macro reversal, could swing sentiment hard in either direction. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. The real test for enterprise isn't quarterly growth. It's whether companies like Atlassian can sustainably convert AI features into recurring, predictable revenue. The Rovo credit framework is the mechanism. The diplomatic thaw and peer performance are the catalysts, but the long-term bet hinges on whether businesses keep paying for AI-powered collaboration at scale. That's what the market is pricing in, not just today's headlines, but the next phase of enterprise transformation. So what should you watch? Not the next stock move. Look instead at Rovo credit consumption metrics and customer adoption trends in the next earnings report. That's the real signal of whether this enterprise momentum is durable or just another spike in a volatile cycle.